Good morning. This is Nick Rach with the Earnings Scout. I'm going to give you an update on how fourth quarter earnings revisions are coming in as the 18 companies in the S&P 500 have reported results so far. Those are companies reporting August quarter ends, the early reporters. I want to talk about financial markets in general to start because this has been a year where the macro is really driving the micro, really thanks to, or no thanks to central bank policy. But in January and February, where you had to be bearish, if you didn't flip the switch and change your sector and industry bets by March, really mid-February, you're not outperforming at all in 2016 in all likelihood. And there's been a lot of studies showing how active managers have done so poorly in 2016, in particular a Bank of America Merrill Lynch survey that showed only 15% of active large cap money managers are outperforming the benchmark, the S&P 500 this year. And again, if you didn't get that macro call right, really shifting from a defensive position early in the year to a more aggressive one by March, you're not doing well. We captured that at the Earnings Scout by following the directions to earnings expectations and actually measuring these in an objective fashion. So very happy to the client base that we have that has done so well. But I want to talk about earnings surprises and people looking at earnings the wrong way. They're manufactured, they're backward looking. 9 companies in the S&P 500 reported last week. All 9 of them beat earnings estimates. The surprises are irrelevant though. We want you to focus on the direction of the estimates. I'm going to highlight the companies that did report. You can see here, this is sorted by the EPS surprise. The number one best surprise last week within the S&P 500 was Nike. It reported earnings of 73 cents for its August quarter versus an estimate of 56 cents. That's a 30.36% surprise. If you notice, the company also beat on the top line by 2.41%. So its sales and earnings exceeded expectations. However, if you look at Nike, the stock dropped 4.5% last week. The stock is down almost 16% year to date. And there's 30 analysts on Wall Street that cover Nike. You know, not one of them has said sell this stock over the past year. We did, though. And the ironic thing here is, though, those analysts on Wall Street that don't put sell ratings on Nike, we're following the changes to their earnings estimates to give us the clues of what's going on about the company and its business momentum that we can then measure based on those earnings estimate changes from these analysts and measuring the direction of how they're moving in a very objective fashion. So while companies that reported last week, we showed you the earnings surprises, this is a more important table. This is their next quarter EPS estimate change. So while Nike was at the top of the list of the 9 companies that reported last week in terms of earnings surprises, in terms of the guidance it provided after and the subsequent analyst estimate revisions after, you could see Nike is at the bottom. So before Nike reported earnings last week, right before that earnings announcements, the estimates for its next quarter, we're going to call it the fourth quarter 16 estimate, which is really its November quarter estimate, was 52 cents. It went down to 43 cents afterwards. So that's a 17% drop in estimates for its next quarter estimate last week. That's why the stock was down 4.5%. And actually, we're going to take this even further. The fact the estimates went down at Nike weren't the reason why the stock price dropped by 4.5%. It's the direction of the estimates. So just because the estimates went down, we say that the stock didn't have to go down. But we want to show you what's happened to Nike's earnings estimates over the past year. So this is our chart that we call the Earnings Scout trend. It's measuring what we have a proprietary blend here of an earnings score that's measuring the overall rates of change to earnings expectations for Nike over the past year. Now, we said the next quarter estimate dropped by 17% last week. This blue line on our chart here is measuring more than just the next quarter. This is measuring multiple quarters and multiple years for Nike. The red line is the price over the past year. And if we look at this, if we go back to last year's third quarter earnings season, after Nike reported, overall estimates were dropping by about 1.15% for Nike. Then you go to fourth quarter earnings season for Nike. Their overall expectations afterward, out in the future, were dropping by 2.89%. Then in the first quarter earnings season, estimates were getting cut multiple quarters, multiple years by 5.63%. Second quarter earnings season this summer, we saw Nike's earnings estimates fall by 8.14%. And then last week, when we look at the overall expectations for the profitability of Nike out into the future, 1 to 2 years, we're seeing those estimates fall by 10.23%. So on our chart here, while the blue line looks lumpy, what we're looking for is all the revisions come in peak earnings season. We're looking for the lower lows in each earnings season. So when we draw on the slope of our earnings scores, we're going to see that the estimate trends for Nike, what analysts thought Nike was going to earn out into the future, keeps getting weaker and weaker over the past year. This is why the stock price is down 16%. That's why we've also had a sell rating on Nike and have not said to buy this stock since we issued a sell rating on the name in the mid to high 50s. Now, as we look at this chart, is Nike at its bottom? This is what we're going to say is still a value trap. And a lot of value investors will see a stock that's beaten down, a high quality company, and definitely Nike is a high quality company. But what we look at here statistically is we can't determine that the worst of the revisions in terms of magnitude down are over at Nike yet at this point. So we don't try to speculate that it is. We wait to see actual proof that the worst is over. And in this case, we can't determine that yet. This is why we're saying Nike, to us in our models, is a value trap at this point. I want to talk about big picture earnings now, the S&P 500. This is the actual and estimated EPS growth rates, the new blended rates, if you will, for the third quarter. And you can see we've had negative to sluggish growth at best in 2015 and early 2016 as well for the 3 quarters. Here's where we're getting concerned here. Look how growth is set to explode by the fourth quarter and first quarter of 17. To us, if this happens, the market's going to be off the races. And we do believe growth is going to modestly reaccelerate. We believe the first quarter, and we've been saying this since the first quarter, that the first quarter 16 period was going to mark the low water point for growth. However, we don't expect growth to explode here that the analysts are suggesting is going to occur. And if we look in here by sector, you're going to see the energy sector itself, where growth has been just atrocious in 2015 and 16. It's set to explode by the first quarter of 17, the second quarter of 2017, looking for 341% earnings growth year over year for the entire sector. Now, we know it's bouncing off of bottom. We also know that that's pretty high and probably too high. Those numbers are going to have to come down. Now, that does mean there's still going to be very solid growth for energy because it's bouncing off the bottom. But the one thing we know you're not going to hear next year, if this is the case and energy is going to bounce, you know all those strategists that are the Purma bulls trying to get you into stock in 2015 that were saying, well, earnings X energy were X. You're not going to see earnings X energy from the Purma bulls in 2017 if this does play out. But we do believe the deltas to the earnings expectations, the improvement in underlying trends, is set to expire here sometime between the third and fourth quarter earnings season. Because remember, stock prices are going to follow the direction to earnings expectations. The central banks are pulling the strings. They saved the day here. They saved the year, in our opinion, early March by the Fed not raising rates. After Janet Yellen raised last December, she kept a lower for longer strategy. Now the Fed is probably going to hike in December. I think there could be a replay of what's going on because not only if the Fed tightens in December, you got those high bogeys for those fourth quarter and first quarter expectations here. So the improvement trends that we're seeing in earnings expectations over the past 7 months, and by improvement, that doesn't mean estimates are going up. It means less negative estimate cuts. We think that's set to expire. We could see weakening earnings expectation trends here sometime between October and February 2017. We think a pullback is likely. Now, before you get too negative here, we do believe policymakers will probably end up stepping in and providing support. Look for that. And as you go through our earnings trends, and we showed you Nike, we got this for 4,500 companies. We objectively are measuring who has the best and worst acceleration and deceleration of momentum that isn't priced in. We aggregate for that for the sectors and industries as well. And if you're interested, in us doing analysis for any of your companies, contact us at sales@earningscout.com, or you can contact me directly at nick.rach@earningscout.com if you have any questions. 7 more companies report this week. We'll be compiling all their data, and not just the surprise data, but in particular, we're going to be compiling the revision data for you to determine if things are getting better or worse. Good luck with your trading this week. And again, contact us if you have any questions. Thank you.